A mutual fund is a type of investment vehicle that pools money from multiple investors and uses that money to buy a diversified portfolio of stocks, bonds, or other securities. The investment decisions in a mutual fund are made by professional portfolio managers, who aim to generate returns for the fund's investors. When you invest in a mutual fund, you own shares of the fund, and the value of your shares is based on the performance of the underlying assets in the fund's portfolio. There are several types of mutual funds, each with its own investment objectives, strategies, and risk profiles. Here are some common types of mutual funds. Equity funds. These funds primarily invest in stocks, and their goal is to achieve capital appreciation over the long term. Example: Vanguard 500 Index Fund, VFIAX, tracks the S&P 500 index and provides broad exposure to large-cap U.S. stocks. Bond funds. Bond funds invest in various types of fixed-income securities, such as government bonds, corporate bonds, and municipal bonds, with the aim of generating income and preserving capital. Example: PIMCO Total Return Fund, PTTRX, is a well-known bond fund that invests in a diversified portfolio of fixed-income securities. Money market funds. Money market funds invest in short-term, low-risk debt securities, such as treasury bills and commercial paper, with the goal of providing safety and liquidity to investors. Example: Vanguard Prime Money Market Fund, VMMXX, is a money market fund designed for capital preservation and stability. Balanced funds. Balanced funds, also known as asset allocation funds, invest in a mix of both stocks and bonds to provide a balanced approach to risk and return. Example: Fidelity Puritan Fund, FPURX, is a balanced fund that invests in a combination of stocks and bonds to achieve a moderate level of growth and income. Sector funds. Sector funds focus on a specific sector of the economy, such as technology, healthcare, or real estate. They aim to capitalize on the growth potential of that sector. Example: Fidelity Select Technology Portfolio, FSPTX, invests in technology-related stocks, providing exposure to the technology sector. Specialty funds. Specialty funds invest in unique or niche areas, such as real estate investment trusts, REITs, commodities, or foreign currencies. Example: iShares U.S. Real Estate ETF, IYR, is an exchange-traded fund, ETF, that invests in real estate securities. Index funds. Index funds aim to replicate the performance of a specific market index, such as the S&P 500, by holding a similar portfolio of assets. Example: SPDRS and P500 ETF Trust, SPY, is an ETF that tracks the S&P 500 index and is designed to closely match its performance. International funds. International funds invest in securities from foreign markets, providing diversification beyond domestic investments. Example: Vanguard Total International Stock Index Fund, VGTSX, offers exposure to a broad range of international stocks. Tax-efficient funds. These funds aim to minimize taxable distributions, making them suitable for taxable accounts. Example: Vanguard Tax Managed Balanced Fund, VTMFX, is designed to be tax-efficient and focuses on a combination of stocks and bonds. Target date funds. Target date funds are designed for retirement planning and automatically adjust their asset allocation over time based on a specified target retirement date. Example: Fidelity Freedom 2050 Fund, FFFHX, is a target date fund for investors planning to retire around the year 2050. These are just a few examples of the many types of mutual funds available. It's important to carefully consider your investment goals, risk tolerance, and time horizon when selecting a mutual fund that suits your needs. Additionally, you should review the fund's prospectus to understand its specific objectives, fees, and risks before investing. Mutual fund life cycle. The life cycle of a mutual fund can be broken down into several key stages, from its inception to its eventual closure. Here's an overview of the typical mutual fund life cycle. Inception and launch. The mutual fund is created by an asset management company, also known as a mutual fund sponsor. The fund sponsor drafts a prospectus, which contains detailed information about the fund's investment objectives, strategies, fees, and risks. The fund is registered with regulatory authorities like the Securities and Exchange Commission, SEC, in the United States. Offering period. During this stage, the mutual fund offers its shares to investors for the first time. Investors can purchase shares directly from the fund, in the primary market, or on the secondary market through brokers or financial institutions. The offering period may last for a set period or be ongoing. Asset accumulation. As investors purchase shares, the mutual fund accumulates assets. The fund's portfolio manager invests the assets in accordance with the fund's stated investment objectives and strategies. Active management. Throughout the life of the fund, the portfolio manager actively manages the fund's portfolio by buying and selling securities to achieve the fund's objectives. The fund may pay dividends, interest, or capital gains to investors on a regular basis. Ongoing operations. The mutual fund continues to operate, with investors buying and selling shares on the secondary market. The fund's net asset value, NAV, is calculated daily to determine the per-share value of the fund. Growth and maturity. The fund may experience periods of growth and maturity, during which its assets under management, AUM, increase. The fund may introduce additional share classes, allowing investors to choose among different fee structures, e.g., Class A, Class B, Class C shares. Changes and amendments. Over time, the fund's management or investment strategy may change, and these changes are communicated to investors. Shareholders may vote on significant changes to the fund, such as changes in investment objectives, mergers with other funds, or changes in the fund's management team. Decline and liquidation. At some point, a mutual fund may begin to decline due to poor performance, changes in market conditions, or other factors. If the fund's AUM significantly decrease, it may become economically unviable to continue operating. Liquidation or merger. In some cases, the mutual fund may be liquidated or merged with another fund. If the fund is liquidated, the assets are sold, and the proceeds are distributed to shareholders. If the fund is merged, its assets and investors are combined with another fund with similar objectives. Redemption of shares. During liquidation or mergers, investors have the option to redeem their shares for their proportionate share of the fund's assets. Shareholders may also have the option to exchange their shares for shares of the surviving fund in the case of a merger. Termination. The mutual fund officially terminates when all assets have been distributed, or in the case of a merger, when the fund is fully integrated into another fund. It's important for investors to monitor their mutual fund investments and periodically review the fund's performance, expenses, and any changes to its objectives or management team. Mutual funds are subject to market risks, and their success and longevity depend on a variety of factors, including investor demand and the skill of the fund's managers.